what we're going to talk about is what's changed in the last 20 years, what are the biggest trends, what the market has been doing over the last 4 years, and why Shell has become such an important part of a strategy for most gas buyers. Is anyone here a part of your procurement team or part of developing what you guys are going to use as far as energy is concerned at your plants? Great. So this is going to be pretty relevant. I wanted to talk to you about the biggest changes. I'm going to bullet point some of these things, and then we're going to look at some of the charts that are available to you on EIA to kind of illustrate these points. We're going to talk about crude oil to natural gas pricing and their relationship. We're going to talk about the introduction of the shale plays. We're going to talk about storage development for natural gas. We're also going to talk about the different indices that are respective of trading points and how this is changing the way you're probably going to set up your pricing formula to purchase natural gas, and also how electric generation is becoming a very large driver in flattening out the futures prices going forward. So when we're talking about the differential between natural gas and how it has historically followed the trend of pricing for crude oil, you can see it's been a very close differential over time. Back in 2008-ish, we started to see this gap widen. At first we thought this was an anomaly because we generally, when crude prices would go up, gas would go up. Now this has changed quite a bit. Crude prices go up, gas prices go down. And there's some significant reasons that you could attribute to the shale production today. So where we were once at probably a 6-to-1 ratio of gas versus crude prices, we're much greater than an 8-to-1 ratio. I'm probably going to use some terminology that may be familiar to you and may not be, so please feel free, maybe raise your hand and say, please explain that if I've started discussing something you'd like to have expanded on. This is a map of shale plays in the United States. Our footprint as a company is up here in this northeast Appalachian market, and it is relative to the Marcellus shale play as well as the Utica shale play. I'm going to talk to you about the difference in the Marcellus and the significant difference in the Utica. We, as a company, market natural gas. It's a dry component of the products that are coming out of the Marcellus. It's the primary component coming out of the Marcellus. As you move west into the Utica, this red area, you're getting into wet hydrocarbons. And those do bring a greater financial benefit to those people who are drilling out there. So we've seen a lot of production in the Marcellus, but as costs have been driving downward in the market, around $2, we've started to see these guys moving from the dry gas production to wet gas production because they're going to get more for the commodity that they're bringing out of the grounds. We really saw a greater move to wet gas production over the course of the last several months. I'm going to show you a chart that shows you the movement of rigs from one play to another play. And that tipping point for these producers was about the $2 mark. Some other significance about these plays is that it has made us a really huge domestic producer of natural gas. Traditionally, we bought gas out in the deep water shale in the Gulf. We bought gas from Canadian producers. And recently, there's been gas coming in on the East Coast and the West Coast that is liquefied natural gas, and we're going to refer to that as LNG through this presentation. The Marcellus is huge. Also, the Haynesville shale is huge. When we're talking about the scope of how big this is, we're looking at comparing something that's setting out in Iran. So we can be very reliant on our own production here. Another big significance about these plays being here in our country is that if you have a plant that's setting anywhere near any of these plays, and if there is adequate infrastructure to get it to your plant, what that means is you're going to cut your cost. You're going to buy gas closer to home. This is changing the scope of how we are pricing customers and how we're delivering to them. We'll discuss that a little bit further. So Shell, what's done for us is we're seeing where natural gas, these are gas components in oil, we're setting about 23% in 2010, 2011. We're seeing Shell being more forecasted in closer to the 50% mark as far as energy production in the U.S. We talked about where we've seen a movement from gas rigs into oil rig production. And this shows back to 2010 where we were when gas prices go down and oil prices go up. The rigs are moving into a different segment of production. So when we see gas prices tilting towards $2, they're going to move out of there. They're going to go somewhere else. So the big question is, where is it profitable for the market to be, for gas to continue to flow to markets close to home? So when we look at how producers and natural gas marketers work together and how we have traditionally worked together, we talked about how we've purchased gas out of Canadian sources, out of the Gulf, and primarily out of the Gulf, off the East Coast for LNG. We're seeing a switch. This is not an anomaly anymore. This is something that is very tangible in pricing and supply. Considering that this is close to home, when you purchase gas close to home, close to your plant, you're going to lower your transportation costs across interstate pipelines. You may have been shipping gas from the Gulf into maybe your market area and using maybe 3 legs of pipe to get it there. When you're buying gas closer to home, you may only need to use 1 leg of pipe. So you're going to lower transportation costs in your formula. You're also going to lower your cost of shrink or fuel. So think of shrink of fuel as the gas to drive a car from point A to point B, and think about transportation as your toll. Also, this has created index differentials. We've talked about the Gulf gas. This is referred to as Henry Hub gas, NYMEX base gas. There are trading points that are named after pipeline, interstate pipeline points. In our markets, mostly up in the Northeast, those points are called Columbia Gas Transportation, or TECO, or Dominion. There are Chicago points. There are East Tennessee points. There's all these points named after pipelines, creating a physical and a financial hub. So where your plant is located, you're going to look for those hubs. Are those hubs close to local production? If they are, there's a different way to buy gas. There's a different way to price gas. And if you put out RFPs, there's different ways of asking for a least cost method of getting gas to your gate, at your utility, and ultimately to your plant. Another thing that's happening is, does everyone know what natural gas storage is? Natural gas storage is something very physical, very tangible. It's something that you can utilize to put winter gas that you're going to consume into the ground and store it during summertime and take it out of the ground or withdraw it during the winter time. This aspect of our industry is available to everyone. Every natural gas marketer has to have it. Every utility has to have it. We have to prove that we have it. If this opportunity is not being presented to you by your natural gas marketer, it's something you should ask about. When I came into this business, there was only about 3.8 probably about 3.2 billion cubic feet of underground storage of natural gas. It has grown over the last 2 decades to over 4 BCFs of gas storage. I want to show you guys this chart because this is available to you every Thursday from EIA. What this does for you is it tells you about the history of underground storage over the last 2 years. But it also gives you some place markers of where natural gas storage inventory has been over the last 5 years. It gives you a 5-year low. It gives you a 5-year high. This red line represents where current inventory is tracking. We've come out of 2 very warm winters, and what has happened is this natural gas storage that was put away either for physical burn or financial purposes has not been pulled out of the ground. Also, we have been seeing natural gas production being used to displace production from shale plays into the ground to move it to market for a later purpose. Natural gas storage has also become a big component of running peakers and producing electricity. So this, where it was traditionally managing our winter consumption, has now become something to manage demand all year long. And it's having a significant effect on where the futures market is going. This chart here above just talks about how this has been utilized over time. So this has been in our market since the early 80s. This is something that's very tradable. Has great value. This is where this new storage is being developed, primarily down here around the salt caverns and the aquifers up in this market. Also in the Marcellus territory, where we're taking depleted gas wells and repurposing them for storage. When we're talking about the gas wells that are located in this region, this is traditional storage. This is putting gas in the ground in the spring and the summer, taking it out in the winter. Down here, this is more flexible storage. This is more costly storage because you can bring it in and out at any point in time. And what this does for you is it helps offer you some flexibility when you're planning for your plant's production, or maybe a special contract you got coming along, and you may think that you're going to have that production in 1 month, but you really don't get it till 2 months out. You have a place to displace that gas that maybe you've taken a position on. And marketers like Stand Energy have this type of capacity available. This is contracted capacity. A lot of these storage wells traditionally have been owned by interstate pipelines, and now they're becoming their own entities. So this is something that's very important, especially if you have flexible demand requirements and if you have a high winter demand. I wanted to put this out here because we're seeing the futures market flatten out. Where traditionally you would see natural gas trade way higher in the winter, you're seeing it trade way lower, or way lower in the summer. It's starting to flatten out when you're looking at the futures market. So today I went out to just take a look at where gas is trading, and we're trading on the 12-month out about $3.90, and it's pretty flat. Every futures month is looking about the same number. When you go out into 2014, we're trading in the 14s, so it's pretty flat. And this is because of natural gas being used for electric production. We're seeing more reliance on data that doesn't only track heating degree days, but also cooling degree days. So this is going to be a component of your budget for your plant for natural gas, as well as electricity. Now, we've talked about how there are different trading points by which you can choose to purchase your gas and build your pricing formula from. Traditionally, everyone has went out to the market and looked at Henry Hub. This first column represents Gulf gas. This next two columns, this is more like a case study for me, so I can kind of talk to you about why this is so important to your plant if you can find a source of gas close to home. the majority of our customers in the Appalachian market can buy gas close to home off of two pipelines, one called TECO and one called Dominion. TECO is Columbia Gas Transmission. When you look at the difference between TECO and NYMEX and Dominion and NYMEX, this differential has, prior to this point, been upwards of 20 cents to 50 cents differential. It kind of represents what the gas is valued at closer to home versus bringing it all the way from the Gulf. What we're finding out now is that as we've moved through greater shale production and bringing gas to market and using gas for peakers and electricity plants, what we're seeing is that this differential has started to shrink to where we've been equal to or less than the Henry Hub. So if you can buy gas and you're buying your commodity closer to home at a lower cost than you can buy from the Gulf, and you're using less pipes to ship that gas through, you're going to ultimately lower your cost of gas. This is a trend. This is forecasted well into the future. So you're going to see a lot of these bullet points repeated because they're still being repeated as trends and also key indicators of where we're going. We're changing the way we use natural gas. We're using it to run cars. We're using it to produce electricity. We're using it as feedstock for certain commodities. Gas-fired generation is going to continue as long as we're decommissioning coal. Dramatic supply growth in the shale, and this is all over the United States. This is on the West Coast, the East Coast, down in the Gulf. We're going to have a lot more supply, and it's going to require a lot more new infrastructure to get it to market. More storage, more everything. Liquefied natural gas is switching from an imported commodity to an exported commodity. We're still going to see, as crude prices go up, we're still going to see those prices go down for natural gas. So you're going to have a definitive way of saving money, and you're going to want to change the way you've been pricing your gas. Renewables. Everybody would love to run everything off of solar or wind, but the fact is the wind doesn't always blow and the sun doesn't always shine. So the only way to supplement when that sun is not shining and when the wind is not blowing is through a different, cleaner fuel, which happens to be gas. I wanted to show this to you just to talk to you about how we've tracked consumption as a nation, commercially and residentially. Residential has always been a huge consumer of natural gas. We're starting to track other things now. We're talking about fuel for vehicles, which is now starting to be tracked. This is on the rise not only domestically but globally. Hence the LNG product we're exporting. We're starting to really look at electric generation, tracking it back prior to 2000. And segmenting commercials from industrials. This is a chart that kind of talks about where we've been getting our gas and where we're shipping it to now. And we're well beyond shipping it to Canada and Mexico. We're shipping it to places in China. They're paying upwards of $18 an MMBTU for their natural gas. So it's pretty significant. A lot of that cost too is regasification of this liquefied product. But they're going to pay that, and it's very, very global. So I've seen this more over the last maybe 12 to 14 months, moving from a very bearish or soft pricing and into a very extended into the futures market, very high pricing for natural gas. So we're definitely moving from a bearish market to a bullish market. So let's talk about the bullish factors. Weather. We're always going to have weather issues. We've always got to worry about what half the nation is doing and what the other half of the nation is doing. We're going to look at forward winter. Half the nation is going to be colder than normal. Half of it's going to be warmer than normal. So what's it going to do? We don't really know. Global demand is growing. We're improving industry, different techniques using natural gas is, like I said, feedstock. Coal and nuclear, there's fears about all that, so we're still going to use gas. It's going to win out overall. And we're going to see it being used as primary energy use of fuel by many segments of our industry. So here's our biggest questions. We're producing so much gas. Where's it going to go in a sluggish commodity? Well, we're going to ship it out of the country. We're going to start seeing more natural gas vehicles introduced in the metro systems of our metropolitan cities. We're going to continue to see all the way out through 2035 the death of coal. Weather's always a factor. This cooling degree day thing is going to be driving your fuel cost as well. Gas and crude, they're not going to come back together. And the Henry Hub pricing is not your best option anymore. Try to learn about these other indices, pair up with marketers who know about these other indices. Maybe it will lower your cost of gas over time. So where is the future prices going? It's pretty evident today in today's market when I'm looking at this. I mean, we're all the way through 2013 looking at gas prices well above $4. Out 2014, 2015, your top side, we believe, is going to be upwards of $6 to $8. It's already evident. We hadn't seen $4 on the futures pricing about 6 months ago. If we had looked back 36 months, you couldn't find $4 on the futures market for several years out. You can usually look at this futures market every day online, going all the way out to 2025, and you wouldn't see $4 for maybe 5 or 6 years out on the strip. Now we're seeing $4 evident in the next few months. So looking at winter, you're going to be well above $4. If you haven't taken positions, it's something you probably should start looking at. So I want to thank you guys for coming. We're going to be at 3:04 if you have any questions. We have about maybe 2 or 3 minutes to take questions.